Okay, thank you for joining us this afternoon, everyone. This is Matt Haller with the International Franchise Association here in DC. Hope everybody is doing well. We're 1 year officially into the pandemic, and we are excited to bring you a really interesting presentation today to kick off a whole new webinar series that IFA is launching starting today and over the course of about the next month. It has to do with IFA's 2021 Economic Outlook. This is a report that our great friends at FRANdata have prepared for IFA members exclusively. And we released this about a week and a half ago, gotten a tremendous amount of media coverage talking about this. It's really helpful to inform both the public conversation around franchising and the policies that impact franchising. And to go through that report, we've got Daryl Johnson, a good friend of IFA's and so many of you in the franchise community to run us through all of that. So just first and foremost, a little bit of housekeeping. Number one, the webinar will be recorded. The slides will be made available. It'll all be posted later today on community.franchise.org. And for those who registered, you will receive an email with a copy of the presentation and a link to the recording. Number two, we're using Zoom, so if you have a question for myself or either of our presenters today, please add it to the chat box or into the Q&A box, and we will address them at the end of the presentation. In addition to Daryl, we are really pleased to also welcome Steve White. Steve is the President and Chief Operating Officer of PuroClean and Chair of the IFA's Franchisor Forum. And Steve will discuss the new direction of the IFA's Franchisor Forum that it's taking this year. Just wrapped up a really great meeting at our virtual convention last month. And Steve is going to review some survey results from a recent Franchisor sentiment survey the forum conducted and some plans for benchmarking surveys that the forum is going to undertake over the course of the rest of this year. So before we open it up, just want to remind folks, use that Q&A box for questions, keep them coming. Daryl will have about 20 or so minutes. Steve will have 5 to 10 minutes, and then we'll do questions at the end. So on that note, I will turn it over to Daryl to get us going.
Thank you, Matt. Appreciate it. Look forward to this. About once a decade, those in the economics profession get an opportunity to assess all of the dramatic change that comes as a consequence of the economy either really taking off or crashing, and try to sort out the implications of it. And that's what we have done in this economic report for the IFA. And I think for many of you, it is both instructive and will hopefully serve as a basis for you to make some important strategic decisions as you look to the next couple of years. I will say at the onset that the franchise business model gets an opportunity to shine usually early in recoveries, and that shouldn't be different this time. Franchising should have the opportunity to take advantage of all of the change that's going on. It's a business model that works well, and we'll get into a little bit of that as to understand why that is and what's likely to come. First of all, we know that we're going to see a nice pop in GDP over the next 6 to 12 months. Part of that is just a function of statistics. When you're coming off a much lower base, it's easier to show dramatic improvement. But some of it is real, and it's been real in the sense that it's been fueled by government programs, by a very accommodative monetary policy, but it doesn't matter the cause of it. The fact is we are going to see a big improvement in GDP and in economic growth. My cautionary note to you, as we'll get into a little bit later, is that you can't be misled into thinking that, wow, this is just a dramatic rush and growth that's going to be sustainable. We'll see that initial thrust, and then it should calm down and start to look at a more normalized recovery. But during that period, it should be a real good opportunity for franchising. Next slide, please. We can look at the implications to the franchise business model across sectors. In order to understand that, let's first look at what happened last year. The economic impact study that the IFA has, or the economic outlook report that the IFA has just released, is chock full of a lot of statistics, a lot of analysis, a lot of directional implications. By and large, what it should show and what you should interpret from that is the franchise business model fared quite well relative to its alternative business models that it competes with, independent businesses, chains. Franchising came through in a fairly strong fashion. Having said that, of course, sectors had difficult challenges, some more than others. Some sectors actually we're seeing robust improvement and opportunity from that. But by and large, if you look at it on a side-by-side comparison, franchising, I think history will show, proved itself quite well in 2020 and is setting the stage for what should be a fairly healthy 2021 and 2022. Next slide, please. What we think is likely to happen this year in the face of what was an unprecedented economic crisis worldwide is that we're going to see business growth, we're going to see employment, improved outlooks, a bigger contribution to GDP. Economies that lost a tremendous amount of economic activity. Some of that activity is gone forever. We're not going to see recovery of a lot of sectors in the form that they went into the crisis structured and operating as. We're going to see change. However, that recovery for franchising looks fairly solid, and it looks like at this point that we at least will return to sort of the lost year last year. We'll return to where we were at about 2019 overall, and if you look at the aggregate numbers, they tend to show that. Next slide, please. I will note as I go through this, there's a lot of information as you're reading on these slides, and that information, while it's instructive, I think, for you to kind of peruse through, I'm not going to read through it, or I'll just pull out a few highlights. And the highlight here is that I think history is always worthy of understanding in the context of what we should expect in the future. And as we know, in the franchising business model, it tends to be a strong model early in recoveries. And I say strong model early in recoveries, that's relative to how other business models start to recover and start to grow. And as we saw in the Great Recession, that certainly is true. And as you can see on this chart, the early recovery period, while the other small businesses generally got to about the same point in 2010, that was largely because the lending community basically shut down all access to capital, so there wasn't much activity for anybody. But as the lending community started to understand the implications of the last crisis in 2010, 2011, they started looking at franchising as a better alternative from a risk perspective than independent businesses. And from that, as you can see, it really took off, and we saw sustained growth for a number of years. We're going to see a similar pattern for different reasons, but a similar pattern this year. Next. There are no surprises in terms of which brands or which sectors performed well and which didn't. If it was retail based, last year it had problems. If it was residential based or business to business based, it tended to have an initial slowdown followed by a dramatic increase in business, some showing year over year gains of a significant amount. And that pattern of behavior at the sector level also tended to play out with most franchisors, most brands within those sectors. Some of the stronger brands, or some of the stronger sectors in residential services, commercial real estate, retail products, business services, showed quite strongly. And the consequence, I think, that we can draw from that, at least on the strength of what we're asking IFA and their government relations team to advocate on our behalf in the legislative world is that the business model was strong, and it is actually moving into a stronger position in some of these sectors where one would expect early growth, and the business model is showing that. Next slide, please. And if we look at a couple of the sectors in a little more detail, the reasons for this growth, and I will say that it's important to understand that even in each of these sectors where growth is most likely, it isn't implying that the sectors that are showing weaker growth, as we had shown there, where we had broken it down into 7 or 8 sectors, those that are showing weaker performance, the implication, this is not a blockbuster video kind of statement that those say in retail food or in retail services are bad businesses. What it says is that there's more variance in those sectors, and even the hardest hit sectors showed strength in some brands that were able to adapt. And in fact, we saw a distinction in many of the franchise organizations where the leadership of franchisors really came to the forefront. Some brands that were adjusting very quickly and understanding the consequences of how both consumer behavior was changing as well as government edicts were impacting their business, and made those changes early on. And as a result, even in some of those weaker sectors did well. But as you could see in the growth sectors, a lot of it focused on residential. FRANdata tracks every new brand that shows up in franchising. And as we have seen over the last couple downturns and early stages of the recovery, you see a lot of brands start to show up in sectors where there's more momentum. After all, and one of the attributes of the franchise business model is to move in quickly and take advantage of the economic conditions that are attractive in certain sectors. And we're starting to see that again, where we're seeing an expansion of brands in certain sectors. We also follow the money. We follow not only the lending community, but also do a lot of work with PE firms. And what we've seen is a concentration of their interest in these sectors that are listed here in growth sectors, especially those around residential services. And while retail is not being abandoned by PE firms and lenders by any means, they're being much more discretionary in how they're assessing them. A lot of this is driven, of course, by the transition of that whole demographic of millennials that are now moving into the age of housing ownership. And that demographic is reflected here as we see that change. Next slide, please. Some of the other sectors, and I'll let you just kind of peruse this. They're reinforcing some of the points that I just made. These sectors are ones where you can see the franchise business model quickly adapting and expanding into it. And you see that in the way of new brands, spin-offs of existing brands where they see opportunity, but under the conditions that have changed now, you see more brands starting to show up that are taking advantage of a slightly different approach to the market, different model, different offering, and adapting to what the consumer behavior changes are. Let's go to the recovering sectors next. As I mentioned here, this isn't to say that these are all listed under the category of, say, blockbuster videos that are all dying. By no means is that true, but what happens, I think, both from a prospective franchisee standpoint and from a capital access standpoint, is the focus on these brands is to look at much more on the transparency side of what's happened. And consequently, these brands, sectors, and the brands operating in these sectors need to be far more communicating of what happened through the crisis and how they evolved through it and where they stand today, because that's what is going to sustain them as they start to come out of this. Yes, we're going to see that pop in GDP, and it's certainly going to play well as we see many of the types of subsectors that are listed here open up to business again. And there will be an initial rush for people to get out and actually re-engage in the economy. But that will settle down, and then we're going to see a more normalized flow of activity. And that's why the lending and the capital provider community, PE firms, are going to be much more discretionary as they look at these sectors. Next slide, please. Finally, QSR table service. Earlier, I mentioned that one of the revealing factors going through a crisis like this is how well the franchisor's management team navigated through this. What kind of leadership did they provide? And I think in these sectors that we're looking at here, in food in particular, with QSR and table service, there was quite a distinction as we looked at getting through 2020, how franchisors first assessed what was going on and then started to change their programs and adapt to what their franchisee base needed. And seeing how that unfolded led to a lot of distinctions in how well the brand ultimately performed in 2020 and how they're positioned today. And we have done a fair amount of work in looking at, in working with, say, the lending community, for instance, in trying to understand that, because in the absence of a leadership on the franchisor level that was able to make these changes and was able to bring their franchise system along in a much more sustained way going through this crisis, there will be another 12 to 24 months of fixing the challenges that we have encountered. It's not clear yet just what the situation will be, because first of all, many of them have not yet opened still. And the government funding programs, particularly PPP, have delayed the consequences of some performance of some franchisees, some small businesses, and therefore franchise systems. So while we're still sorting through that, it is clear that franchisor management team leadership became a more visible measure of how well the brands have done. By and large, even in sectors like this, as we know, some of the QSR brands in particular, not only adapted, but actually had better results over the course of the year because they were able to get out earlier with home delivery, with curbside service, with drive-through. They were able to actually gain business because others weren't able to do that. So we did see a lot of change that took place and a distinction in how franchise systems performed. But by and large, as I said at the beginning, relative to other types of businesses, the franchise business model came through this crisis in pretty strong fashion. Next slide, please. We've, in the economic study information that hopefully you will look at, there's a lot of data and a lot of information about where growth has happened, where both regionally from a demographic standpoint, overlaying that with how the pandemic had impacted states and regions. And this is an example of it, and I'll show a couple more here just to help you understand that. The Southeast, for instance, has the largest number of franchisees of any of the regions of the country. It's also positioned to have a considerable amount of growth, as you'll see in a moment. So if you see the distinction of overlaying this slide with the next one, if we could go to that, please. Start to see where the impact of the pandemic was greatest and where it was least. And as you can see, Northeast, far West, significantly more impacted by the crisis. And if you combine that with what you just saw in the regions, we can go to the next slide and see where the highest expected growth rates are. And if you start to combine all these three, it starts to drive an implication to the system expansion, where the opportunities are in the near term, where franchise brands are positioned today, and where those growth opportunities are likely to be over the next 12 to 24 to maybe even 36 months. It's also important to keep in mind a point that I made just a couple minutes ago, and that is there was a distinction in how franchise brands, how quickly they understood, assessed, and were able to get their franchise system to adapt to the changed behavior. And if you combine all those things, you can, I think, see a fairly clear picture of how franchising at the brand level is performing relative to the sector overlay, the geographic overlay, and then the pandemic overlay. And so all of that information in some sort you can tease out of the economic report that the IFA has available to you. Next slide, please. I would wrap up with a couple things, and we characterize this a couple different ways, but I would wrap this up as just characterizing it as a roadblock to future growth. And by far the most important one that I would ask all of you to give consideration to is not taking the assumption that GDP is going to start popping back up. It's going to actually be very strong in the second half of this year and sustain that into next year. Well, that's fueled by government actions, by monetary policy as much as anything. That's not sustainable long term. So the real question that you should be asking yourself now as you start to build towards the future is, what has changed? How has consumer behavior changed in our sector? What have other brands done to understand, adapt, make changes to that? Because it's not business as usual. There's almost no sector that came through unscathed in how the consumer is likely to engage that relationship. By extension, that second bullet point of how the technology adoption has changed, how the consumer interacts, behaves, is expected to behave. This isn't just about, I want home delivery. This is about how transactions are conducted, how they expect to engage with a brand. Those things have been, we've spent the last now almost 18 months, 14 months, forcing the consumer to behave differently. Not just suggesting it, but requiring it. Some of that will be sustainable for not just the next 12 months, but likely permanently. And understanding that consumer behavior, how technology has changed some of that, those are two things that I would ask you as you start to plan for the growth that should be realized coming up, that you give consideration to and be thoughtful about. We're doing a fair amount of research and analysis around that topic because it is different. It's changed not only at the sector level, but even within the particular brands, how they're looking at it and how they're perceiving it. So with that, I would leave the last 2 points and I'll turn those back to you, Matt, because those are ones that in terms of roadblocks, those are pretty major things right now.
They are, and in my crystal ball here, I will look at to determine, where is Joe Manchin and Kirsten Sinema going to land on the legislative filibuster? And those are the two most important people in Washington right now, because the ability to enact a $15 an hour minimum wage at the federal level, or allow things like the PRO Act to advance legislatively, really are caught up in this broader conversation that's taking place right now around, will the filibuster remain in place? And not to get too much into Washington speak, but that legislative filibuster is really something that makes the Senate function incredibly differently than the House of Representatives, in a true collaborative legislative body where, even when you have one party rule, but bipartisanship, needs to rule the day. But what I've been telling all of our members, and we've gotten 2 questions about this PRO Act impact in the chat already, is the only way that we can guarantee that it doesn't matter what happens to the legislative filibuster is by making Congress aware that the impact of the PRO Act, and specifically the impact of an expansion in the joint employer standard or an application of the AB5 rule at the federal level to franchising, is unacceptable, and that it would dramatically disrupt the way that the franchise business model has traditionally operated. And I think tying it a little bit into what Daryl talked about, and we've done this in a letter that we actually sent up to the Senate today on the nomination of Marty Walsh to the Department of Labor. We said, look, franchising is poised to recover essentially all of its losses over the last year by the end of this calendar year. The only thing that is going to make that impossible for us to do is the enactment of these two policies. There are lots of other, small business issues that could raise the cost of doing business on taxes or labor that are going to be across the board. Joint employment and the application of this AB5 test to the franchise model is completely disruptive to the way that our members do business using a franchise model. And in particular, that business model has created this opportunity for support created this opportunity for really quick recovery from this downturn because of the support that franchise brands are able to provide to their franchisees. And that is the exact type of support that's being put in jeopardy if you expand liability through an expanded joint employer standard. So those are really key points. They resonate. They're very policy focused, but they're real. And these are real impacts that are, we've all been through what that expanded standard was during the 2015 to 2018 time period. And what the PRO Act does, or what a rulemaking would do at the Labor Department, goes way beyond what we've dealt with in that previous time frame, where it was really a reinterpretation through case law. This could be statutory, and that would be permanent. So it's not a guarantee, but the only way to avoid it is to educate, and to educate on the Hill, educate in the states, educate through the media and through IFA. So we can't do that without our member support and great data to back up those arguments, and that's hugely important to what we do at IFA and to all of your businesses. So with that, why don't I bring in Steve for some context around how all of this great news was part of the discussion around the Franchisor Reforms meeting last month at our virtual convention. And for those who weren't able to participate in that meeting, look a little bit over the horizon of where the Franchisor Forum is going from here to provide really good value to IFA franchisor members. Steve, take it away.
Thank you, Matt. Thank you, everybody, for joining us today. Daryl, thank you for that presentation. Super valuable information for all of us in our sector. So what's the role of the Franchisor Forum in this, and why are we here today? It's to talk a little bit about what do we do with the results? How do we have dialogue about it? How do we go forward with it? And the genesis of this new effort really came from our association leader, Catherine Monson, last year, when she asked me, as the incoming chair of the Franchisor Forum, to try to completely reimagine that forum. As we all know, we have a super strong supplier forum and an up and coming franchisee forum, but the Franchisor Forum is kind of laying dormant for a period of time. So we went to work on that. I, along with now vice chair of the Franchisor Forum, Graham Weimiller from BNI, went to work on this. And where we really began is with a review of a research project that IFA conducted last year. So it was, we did a research project on member value research, or member value in IFA, and that was presented to the board last year by our Chief Revenue Officer, Jennifer Brandine. Her team was largely responsible for this. And so we went there and said, how can we add value as a Franchisor Forum? And I've taken the liberty of taking some of Jennifer's slides and highlighting some of the points that we thought were important as a Franchisor Forum. And you can see them on this slide. And we just see a new vision for where we want to go with this whole forum. You can see people want to be more engaged. They overwhelmingly view resources for best practices and training as primary membership expectations. Want more of that, more communications, ultimately leading to best practices and benchmarking. If we can go to the next slide, a value snapshot and building value. Again, in the center, you see data research, which we're talking about here today, but also insights, business resources and collaboration as important value points for IFA membership. Next slide, please. And here, more data research and insights about benchmarking, trends, industry leading voice, becoming that industry leading voice around standards, ethics, business model, best practices, benchmarking, leading to peer networking and mentoring. All of these things are good for the growth of our franchise community. Next slide, please. So that they all go toward these strategic priorities for 2021, which we're in the midst of now. And again, if you look at the highlighted areas of best practices, extended event value, some of these other things out here, that's what we took away from this. And that's what we wanted to be our starting point for the reimagining of the Franchisor Forum. If we can go to the next slide, please. So as we all affectionately refer to it, the ZOR Forum, what is the value of it? Well, we see activities that are about gathering information, distributing information, but really seeing a lot of value coming out of discussing information and the community that builds. And, you know, our intended results are to increase member engagement. We want people to be more involved and feel a greater sense of value as a result of their involvement, and to develop best practices and some of these other things that we talked about. And then next slide, we talked about our implementation ideas, which really have already begun. We made a presentation on these ideas to Catherine and to Charlie Chase late last year. They greenlighted the effort going forward. And so our little coming out party was in the midst of the IFA convention. So on Friday, February 19th, we held a meeting. And frankly, we didn't know what to expect, because if you've been to a Franchisor Forum meeting in recent years, we're lucky to get 20 or 25 people in the room to even talk to each other. It's scheduled up against other meetings. People have conflicts, busy schedules. So we didn't know really what to expect. What we definitely did not expect is the result we got. And that was more than 250 participants online that day on February 19th to talk about these new ideas and where we might go with them. And that the ideas were received with a great amount of excitement. And so we really feel good about that. And part of what we wanted to do there is to do some online polling. So the online polling we did there was very unsophisticated, and it's not meant to take the place of anything that FRANdata is doing. Their polling is of course far more sophisticated and therefore more valuable to us. But we also see value in snapshot polling, which then directly leads to dialogue, conversation within the leadership of the franchise community, and ultimately turns into action and moving us forward beyond consuming the information. So we're going to share with you the results of that snapshot online on polling. And so here's some of the things that we looked at. System-wide sales. We wanted to see what happened in system-wide sales in 2020. And so as you can clearly see here, 60% of the respondents of this poll saw their business down last year. And 25% of us saw our business down more than 10%. So no surprise there. Extremely challenging year. But, you know, we did have a significant amount of the community that was also up. So 39% of us were up last year, or if you include no change, 41% of us. So that was last year. And then we wanted to ask franchise leaders, okay, those are the results that you experienced last year. What do you anticipate this year? What do you see going forward? And that's the graph that's side by side with it, system-wide sales projection for 2021. And it's 64% of us see our businesses rising, growing more than 10% in system-wide sales this year. So we are an optimistic bunch. I think it bears out some of the results that Daryl just showed us. And it tells us a little bit where we go. Very few of us see our business continuing to be down this year and the next. Let's go to the next slide, please. We also talked about total unit count. We've all heard about units closing because of the pandemic and where we were. this gave us a little bit of a snapshot of where we were. 16% of us lost more than 10% of our units, and 14% of us lost some number of units. Amazingly, 22% of us were up more than 10%. And so, as we all know, in an economic downturn, there are people who shake out of the corporate world and they end up in franchising. And I think this is an indicator that that started happening almost immediately. And then as we look forward to this year, what do we think will happen in 2021? So 87% of us see that we're increasing our total unit counts this year. So that's pretty amazing. That's a huge number. Maybe we're 250 incredibly optimistic people, or maybe franchising is really just that much on the move, but it's good stuff for us to chew on and talk about. If we can go to the next slide. We also asked about employee headcount. How did you experience that during the pandemic? And, not surprisingly, 30% of us were down. 20% of us were down more than 10% in employee headcount. But we also preserved a whole lot of jobs. 36% of franchising, at least in this particular group, made no change, and 29% actually increased employee headcount last year. And then if you look at the side-by-side projection for 2021, again, very optimistic. So 64% say up, very few people say down. We're looking forward into this new world boldly and bravely. And let's go to the next slide. Our last slide is really a demonstration of, beyond good dialogue among the leaders of franchise community, what else can this kind of polling and dialogue do? And we think that we can help be more involved in the government relations effort that Matt and his team lead for us every day. And this was a snapshot poll where we said, standing where we stand here today on February 19th, what do we see the future of PPP? Do we need that extension beyond March? Because it was set to expire at the end of March. And 42% of us said, yeah, we really need that to go beyond March. And those are numbers that our government relations team can take to the Hill and talk to people in Congress about that affect the laws that are made around us and programs like PPP. So super important for us to be able to do those things. So what we tried to do here very quickly is show you that we want to have dialogue. The leadership of our association wants to go beyond doing research and sharing it to getting us to engage with each other, to have dialogue about where we think we are and where we think we're going. It helps us make good decisions as an IFA board of directors. It helps our government relations team in what they do every day. And we think it can be a much more effective forum going forward. We also think it could be a pretty exciting place to be and a lot of fun to be involved in. And so coming out of there, we already have a plan forward. There are already meetings being scheduled. Our next one being scheduled is April. If you don't know about it and would like to, you can reach out to Matt and Hader and their team. They're helping us with all of our scheduling. And so we look for us to do more of these snapshot polls and forum discussions around there. That's what we want to do. That's where we want to go. We want to be an engaged community that is coming together and talking and communicating with one voice ultimately. So that's the goal of what we were trying to do today. And with that, Matt, I will turn it back to you.
Thank you, Steve. It is exciting. It is very useful to us. And we look forward to the partnership and more engagement from all of you. Okay, so we've got a good number of questions coming in and probably have time for more. So don't be shy if you want to send them in on the chat or the Q&A function on Zoom. Thank you, Steve. Daryl, the first one is for you. And the question is, what's the impact of the credit markets and how lending institutions are approaching the franchise sector, given the events of the last year, and any perspective on that and how that's playing into the numbers that you forecast?
Thanks, Matt. That's a very relevant question because we've had PPP just flooding into it. It's distracted lenders from doing either conventional lending or traditional SBA lending. So we've had a dramatic change, and that's changed how lending has been done and what lenders focus on, as well as what franchise systems have experienced. Let me give you a little bit of perspective to answer that, because it's not a simple, well, there is one simple word that I can use, and that's transparency. And we are at a period right now where lenders want to know a lot more about what happened last year, how a brand navigated through the crisis, and as importantly, what are the consequences for the future? Because there are brands that are going to be focused internally for the next year or two, addressing the weaknesses that they encountered, the challenges that they suffered from going through this crisis. There are other brands, not just in good sectors, but in some of them in difficult sectors, that found a way through to get through this and did well. Well, the issue here is that type of transparency is going to rub entirely against what the legal community is going to be asking franchisors to be careful about, which is things like item 19 and item 20, and put a lot more footnotes in on a lot less disclosures. What NASA, the state regulatory group, has imposed, there are just a lot of things that are going to push against greater transparency. Just to put it in perspective, and I apologize for making this a little longer, but capital access going out of this crisis, where franchisors have momentum, is going to be critical to them being able to take advantage of that momentum, because without capital, they don't have franchisees. In order to get that capital, that transparency has to be greater. To put it in perspective, in the last crisis, banks went into the crisis, the Great Recession, assuming that franchising was a lower risk, and consequently, they had lower underwriting standards. They found out that some brands were taking advantage of that, and some brands were growing too fast, had less screening, had weaker operational standards, and suffered the consequences for it. They ended up with a lot of bad loans. They didn't want to repeat that, and so they learned from that. And that's what they bring forward to the understanding today. And now we have transparency that rubs right against the push that many franchisors are going to be getting from legal counsel and from the concerns about just even understanding how do we represent what actually happened last year. Well, lenders need to know that. Franchisors need to find ways of doing that. What came out of the last crisis, that's why we created bank credit reports for the lending community to better understand what brands are doing. That's where the fund scoring model originated, to help lenders understand that. And now we're having to rethink some of that in the context of helping lenders better understand how they assess credit today. So it's very much in flux right now, and a lot of lenders are trying to understand a better way of underwriting brands, and that is ultimately going to land on that one word, transparency. Matt?
Thank you, Daryl. It's a massive puzzle right now for what the Biden administration and Congress are looking at as well. But it's really helpful for us to hear that feedback at the association too, about what's happening in the credit markets, and if we need to put more emphasis on some of the SBA programs and some of the enhancements there. Mm-hmm. We've been prioritizing the Section 1112 payments getting refunded, which ran out, which was a huge provision in the CARES Act last year, but there was not enough money put there, as well as increasing loan sizes and extending those, we'll call them SBA 7A enhancements, the higher guarantees and waived fees. So that's helpful for us to continue to hear just generally what's going on in the credit markets. But totally different question. This might be one, I don't know if we have Steve or Daryl, if you've heard this, but it's a really interesting one. Is there an estimate on what an average franchisor has spent through COVID? That'd be more of a benchmarking type question, I think, but also obviously that has impact on capital, from a cash flow standpoint too. So that really goes for either of you guys.
I've not seen any number around that, but I think it's exactly the kind of thing that makes a great discussion in an upcoming franchisor forum meeting. That's one of those things where we can ask people in a poll and get some dialogue going about it and really kind of get to it. Unless, of course, Daryl, maybe perhaps you get better data on it.
Well, we're starting to see that because we do get the financial statements of every franchisor every year, and we have quite a database of that. So we're able to compare year to year. So at a generalized level, we should be able to assess that reasonably well against what certain metrics need to be applied, which the size of the system, whether they were adding or losing units, if they had other things going on within the brand, and to normalize that. But I think the question is really is more specific, is what did they spend specifically related to COVID? And that one is one that requires a fair amount of understanding of what individual brands did, because otherwise you end up with quite a collage of answers, but everyone answered a different question.
Yeah, survey design would be challenging on that one. May need a little bit more of a qualitative approach, but that's certainly something that in discussion at the franchisor forum could be constructive in sort of peer sharing types of expenses. Another question, this is very restaurant industry specific, and kind of the K-shape that exists between QSRs and more traditional full service restaurants. But Daryl, do you see QSR sales dipping once indoor dining restrictions have been fully lifted across the country?
I'm sorry, ask the last part of it again. Do we see where they haven't been?
No, I think the question is coming from a more traditional, full service restaurant. But do you see QSR sales dipping once full service inside dining restrictions are lifted?
That's part of what I alluded to in the discussion I had a little bit ago with the slides, is that consumer behavior itself has changed, and understanding how it's changed. We're still early in trying to understand that. I think the answer is yes, there will be a shift again, because there has been a disproportionate move towards those food providers that were able to get to curbside service, to take out delivery, to outdoor service, that were able to adapt quickly, and they became the fewer competitors in that environment. So that's going to change for sure. The question is, what will it look like on the other side of it once we've kind of gone back to a regular behavior? How much has consumer behavior been permanently changed as a consequence of this? And we're still trying to assess. I don't pretend to have a good answer for that, but I will tell you that it is an important question to pay attention to, because the one thing I am confident in saying is consumer behavior has changed, and it has changed permanently in some ways. And to understand that, we still have to play the tape a little longer and see what transpires in the early period of this reopening of the economy. But once that happens, I think we need to pay attention to the fact that there will be changes. And the changes may not just be a shift between one subsector to another, or a propensity to spend more money in a one subsector versus another. It's how they engage that relationship. Are they going to still wait at a table service restaurant for the service provider to bring the check at the end of the meal, or will they have already taken care of that before they walked in the door? We've forced consumers to behave differently. The question is how much of that will be sustainable afterwards.
Right, and we will do deeper dives on questions like this on April 15th and April 20th. As I mentioned at the beginning of the program, we're going to be doing sector-specific deeper dives with perspectives from within that industry and suppliers that service those industries in the 10 categories that the report measures. So April 15th and April 20th, we'll look at the quick service restaurant sector and the full service restaurant sector as well. So keep an eye on your calendars for invites to those webinars. And I believe if there's any suppliers out there watching, we're still looking for a sponsor for each of those restaurant-focused webinars. So you know who to contact for that on the IFA
Matt,
team.
let me just add one other
Yes,
thing,
Daryl.
and then I want to kind of pitch what Steve was just talking about with the franchisor forum in this context. One of the strengths of the franchise business model is everyone has the same model that they're executing, whether they're in QSR, whether they're in table service, whether they have 2 units or 2,000 units. That feeder system of intelligence, that feeder system of awareness of how the consumer is behaving and what's working and what's different is something that's largely untapped, but hugely valuable. And the question is, how does we as a IFA, as an organization, and those of us that are serving the franchise community take advantage of that in order to continue to strengthen the business model?
Thanks, Daryl. So one question that I think is interesting, and I don't believe is here, but I know both of you would have perspective on this, has to do with franchise brands that are focused internationally. And what data or trends do you see, if any, that correlate to global trends from a franchise development perspective or GDP growth perspective?
Well, we do a fair amount of work with international brands, and I do some work in various markets across the world. We have an affiliate in Australia and one in Germany, and I think the general answer to that is that each market seems to be behaving a little differently at the moment, and some markets are actually ahead of where we are here and doing quite well, and others are going to have a much longer road to recovery. But there's a lot more divergence on that. It's not, well, that particular country, given that it has a fair amount of franchising activity, should be a good one to go into. Now there's some additional factors to consider, not just in how much of an impact the pandemic has had, but some of the legal and legislative consequences of how the pandemic unfolded in those countries now are being overlaid as well.
Yeah, that makes sense. How about there's a good question here as the recovery continues. Any perspective or analysis done on real estate leasing and trends or market strength and how this may impact new unit growth opportunities? Obviously, the commercial real estate market and the residential, for that matter, has taken dramatic impact here in a lot of ways. And our friends in at the International Council of Shopping Centers, we've worked closely on some of the COVID relief efforts with them. But there's a lot still to come, I fear, in that sector that hasn't fully bled through the system yet. Just curious, Daryl or Steve, from your perspective there.
I would offer 3 quick comments. The first is, if the commuting pattern for employees in a particular city changes by just 1 day a week, their buying pattern along that commute, either lunch, stores that they go by, places they stop on the way to or from work, are affected by at least 20%. 1 day a week. Well, a 20% impact is a pretty dramatic impact for any of us to encounter. And if it's 2 days a week, do the math. It's dramatic. So that's my first point. My second point is that we have forced not just the work from home environment, but we have forced consumers to behave differently. And in forcing that, it's changed, I believe, the retail structure. How do you position a brand within a 4-wall space to accommodate how the behavior has changed? I mentioned a few minutes ago just how is the payment processing done now? Well, if I'm sitting in a store, if I'm a membership service, how am I engaging in that? Those things we've forced consumers to behave differently on. And now are we just going to go back to the way it was? In some cases, yes, but not in all. And I think that's the second thing I would consider, is that the consumer pattern itself is changing. And the final one I would mention is that as franchisors make changes to their model in anticipation of how the consumer behavior has changed, are they going to end up with a bifurcated franchise system where you have the legacy operators and the new operators? Managing that and managing it through the transition period is going to be a significant challenge for franchisor leadership.
Thank you, Daryl. I think that's a whole webinar topic in and of itself for sometime later this year. Thank you for that question, Kevin. I think we have time for maybe two more here before we wrap up. Daryl, question around the minimum wage, and if there is an increase in the minimum wage, or other, I'll throw in if there's other issues that cause the cost of labor to increase, which is what an increase in the minimum wage would do. There's going to be a positive impact from the workers that will have more disposable income, albeit at the lower part of the economic model. Agree with that premise as well. What do you think the impact on business would be with a higher minimum wage on the positive side? So a bit of a leading question, but your perspective on an increase in the minimum wage generally would be welcome, I think, for the audience.
Here I would offer two things. The first that I would offer is that whenever you have a change in either the cost of labor or the cost of capital, you have a shift between the two of them, because it's a relative thing. If labor gets too expensive, you see capital alternatives coming in and investment, whether it's in technology or in other things, that replace it. So the question is, if the minimum wage jumps dramatically, you will accelerate the transition of labor for capital, or capital for labor. And in doing so, you're going to exacerbate the lower skilled, lower waged community. And instead of actually being helpful, it's actually going to hurt. So it's a relative question, not only for capital and labor, but it's also a relative question of how much the labor cost goes up. Now, a positive point on all of this: inflation. If we have a rise in minimum labor, if we start to see the acceleration of inflation, which is likely to be a consequence of government spending over the last 12 to 18 months, because we've had a contraction in the overall size of the labor force, the participation force, even though unemployment is high, it is coming down, and it's going to come down quite a bit. But part of the reason that number is going to drop below 5% in the likely to in the next 12 to 18 months is because we're having a decline in the participation rate of labor for a lot of different reasons. Spouses that were forced to handle daycare for their children, some of them are not going to re-enter the workforce. There's a lot of different reasons that are going on. But my point in this is that if we have some degree of inflation, for the first time in over a decade, we're going to have some pricing opportunity, or some return to ability to raise prices. And if we can raise prices for a lot of our goods and services, we may be able to offset some of the labor cost changes. Nothing's guaranteed, and it's all kind of a relative thing, but that may be helpful.
It sounds like you've read the CBO report, which effectively says exactly that. There are benefits and there are consequences, and where that all washes out is a bit of a challenge. But there's obviously a major political component to this discussion around minimum wage as well. Last question, Daryl, and we'll end it here. So 30 seconds or less. Will brands who had high PPP loans have any lending constraints for new capital going forward?
I'm not sure the context with which that question is posed. I can only assume that the view is that if they had a lot of PPP activity, they may have had the perception of weaker franchisees. I'm not quite sure I understand the question, but I think on the surface, I believe the answer would be no. I think the first round of PPP was available to darn near anybody that met pretty liberal standards. And so that round was not a difficult one to meet. And so I'm thinking a higher participation rate by a franchise system that would not be viewed as a detriment. Perhaps I'm not understanding the question, or at least the perspective that was taken to pose that question, but that's how I would answer it.
Well, I can connect you with the asker, and we can take that one offline. Thank you for that question and that answer. I'll take this last one here. So from an anonymous attendee who says, does Congress understand that franchising is different from Uber and Lyft, and that franchisees invest thousands, if not millions, into their franchise? Do they consider what happens to the franchisee's investment if they're made into employees of the franchisor? Depends who you ask. Like I said in the middle of this webinar, education is the biggest way we can make sure that Congress understands that. And the best way to do it is a first-person example. So engage directly with your member of Congress. IFA can help facilitate that engagement with them or their staff. And you can reach out to me at mhaller@franchise.org if you're interested in doing that. With that, I want to thank Daryl and his team at FRANdata. I know they spent a lot of time and a lot of work on this report for IFA. It's great value. It's available on franchise.org, the entire report. As I mentioned, this webinar and the recording with the slides will be emailed to attendees and posted to community.franchise.org after the session wraps up today. And thank you, Steve White from PuroClean. Enjoy the lovely Florida weather this afternoon. And thank you for your work along with Graham, leading the turnaround of the Franchisor Forum and all the great work that you put into it to date. And for those interested in the rest of this series, save the dates on your calendar for the upcoming 9 additional webinars to do deeper dives into sector-specific spotlights. Thanks to Daryl's and his team's great work. So thanks, everybody. Be safe.
Thank you. Real pleasure.